trial balance. 3 subtopics will we discuss. First, meaning and features. Second, purpose of a trial balance. Third, limitations of a trial balance. Meaning and features of trial balance. Trial balance is a list of closing balances of ledger accounts on a certain date and is the first step towards the preparation of financial statements. It is usually prepared at the end of an accounting period to assist in the drafting of financial statements. Ledger balances are segregated into debit balances and credit balances. Asset and expense accounts appear on the debit side of the trial balance, whereas liabilities, capital, and income accounts appear on the credit side. If all accounting entries are recorded correctly and all the ledger balances are accurately extracted, the total of all debit balances appearing in the trial balance must equal the sum of all credit balances. For purposes of a trial balance. First, trial balance acts as the first step in the preparation of financial statements. It is a working paper that accountants use as a basis while preparing financial statements. Second, trial balance ensures that for every debit entry recorded, a corresponding credit entry has been recorded in the books in accordance with the double entry concept of accounting. If the totals of the trial balance do not agree, the differences may be investigated and resolved before financial statements are prepared. Rectifying basic accounting errors can be a much lengthy task after the financial statements have been prepared because of the changes that would be required to correct the financial statements. Third, trial balance ensures that the account balances are accurately extracted from accounting ledgers. Fourth, trial balance assists in the identification and rectification of errors. Limitations of a trial balance. Trial balance only confirms that the total of all debit balances matches the total of all credit balances. Trial balance totals may agree in spite of errors. An example would be an incorrect debit entry being offset by an equal credit entry. Likewise, a trial balance gives no proof that certain transactions have not been recorded at all because in such cases, both debit and credit sides of a transaction would be omitted, causing the trial balance totals to still agree. Types of accounting errors and their effect on trial balance are more fully discussed in the section on suspense accounts. How to prepare a trial balance. Following steps are involved in the preparation of a trial balance. First, all ledger accounts are closed at the end of an accounting period. Second, ledger balances are posted into the trial balance. Third, trial balance is cast and errors are identified. Fourth, suspense account is created to agree the trial balance totals temporarily until corrections are accounted for. Fifth, errors identified earlier are rectified by posting corrective entries. Sixth, any adjustments required at the period end not previously accounted for are incorporated into the trial balance. Unadjusted trial balance. An unadjusted trial balance is a trial balance which is created before any adjusting entries are made in the ledger accounts. A trial balance is a list of the balances of ledger accounts of a business at a specific point of time, usually at the end of a period such as month, quarter, or year. The preparation of a trial balance is very simple. All we have to do is to list the balances of all the ledger accounts of a business. Since in double entry accounting we record each transaction with equal debit and credit effect, therefore the total of debit and credit balances of the trial balance are always equal. Any difference shall indicate some mistake in the recording process or in the calculations. Although each unbalanced trial balance indicates mistake, this does not mean that a trial balance which is balanced is always correct. It is quite possible for incorrect journal entries to not unbalance the trial balance, and they may escape unnoticed if individual journals and ledgers are not reviewed carefully. Examples of such errors are to omit an entry, to record a transaction twice, to record an expense in the wrong expense account, etc. After the preparation of an unadjusted trial balance, the next step in the accounting cycle is to pass adjusting entries. Adjusting entries. Adjusting entries are journal entries recorded at the end of an accounting period to adjust income and expense accounts so that they comply with the accrual concept of accounting. Their main purpose is to match incomes and expenses to appropriate accounting periods. The transactions which are recorded using adjusting entries are not spontaneous but are spread over a period of time. Not all journal entries recorded at the end of an accounting period are adjusting entries. For example, an entry to record a purchase on the last day of a period is not an adjusting entry. An adjusting entry always involves either income or expense account. There are following types of adjusting entries. First, accruals. These include revenues not yet received nor recorded and expenses not yet paid nor recorded. For example, interest expense on loan accrued in the current period but not yet paid. Second, prepayments. These are revenues received in advance and recorded as liabilities to be recorded as revenue and expenses paid in advance and recorded as assets to be recorded as expense. For example, adjustments to unearned revenue, prepaid insurance, office supplies, prepaid rent, etc. Third, non-cash. These adjusting entries record non-cash items such as depreciation expense, allowance for doubtful debts, etc. This example is a continuation of the accounting cycle problem we have been working on. In the previous step we prepared an unadjusted trial balance. Here we will pass adjusting entries. Relevant information for the preparation of adjusting entries of Indorio Company. First, office supplies having original cost $4,320 were unused till the end of the period. Office supplies having original cost of $22,800 is shown on an adjusted trial balance. Second, prepaid rent of $36,000 was paid for the months January, February and March. Third, the equipment costing $80,000 has useful life of 5 years and its estimated salvage value is $14,000. Depreciation is provided using the straight-line depreciation method. Fourth, the interest rate on $20,000 note payable is 9%. Accrue the interest for 1 month. Fifth, $3,000 worth of service has been provided to the customer who paid advance amount of $4,000. Adjusted trial balance. An adjusted trial balance is a trial balance which is prepared after the preparation of adjusting entries. Adjusted trial balance contains balances of revenues and expenses along with those of assets, liabilities and equities. Adjusted trial balance can be used directly in the preparation of the statement of changes in stockholders' equity, income statement and the balance sheet. However, it does not provide enough information for the preparation of the statement of cash flows. The format of an adjusted trial balance is same as that of an adjusted trial balance. The totals of an adjusted trial balance must be equal. Any difference indicates that there is accounting error in the journal entries or in the ledger or in the calculations. The next step of accounting cycle is the preparation of closing entries. Closing entries. Closing entries are journal entries made at the end of an accounting period which transfer the balances of temporary accounts to permanent accounts. Closing entries are based on the account balances in an adjusted trial balance. Temporary accounts include: first, revenue, income and gain accounts; second, expense and loss accounts; third, dividend, drawings or withdrawals accounts; fourth, income summary account. The permanent account to which balances are transferred depend upon the type of business. in case of a company, retained earnings account, and in case of a firm or a sole proprietorship owner's capital account receives the balances of temporary accounts. Income summary account is a temporary account which facilitates the closing process. Closing entries are better explained via an example. Note: first, service revenue account is debited and its balance is credited to income summary account. If a business has other income accounts, for example gain on sale account, then the debit side of the first closing entry will also include the gain on sale account and the income summary account will be credited for the sum of all income accounts. Second, each expense account is credited and the income summary is debited for the sum of the balances of expense accounts. This will reduce the balance in income summary account. Third, income summary account is debited and retained earnings account is credited for an amount equal to the excessive service revenue over total expenses, i.e., the net balance in income summary account after posting the first two closing entries. In this case, $85,600 minus $77,364 equals $8,236. Please note that if the balance in income summary account is negative at this stage, this closing entry will be opposite, i.e. debit to retained earnings and credit to income summary. Fourth, the last closing entry transfers the dividend or withdrawal account balance to the retained earnings account. Since dividend and withdrawal accounts are contra to the retained earnings account, they reduce the balance in the retained earnings. The last step of an accounting cycle is to prepare post-closing trial balance. Post-closing trial balance. A post-closing trial balance is a list of balances of ledger accounts prepared after closing entries have been passed and posted to the ledger accounts. Since the closing entries transfer the balances of temporary accounts, example, expense, revenue, gain, dividend and withdrawal accounts to the retained earnings account, the new balances of temporary accounts are zero and therefore they are not listed on a post-closing trial balance. However, all the other accounts having non-negative balances are listed, including the retained earnings account. The preparation of post-closing trial balance is the last step of the accounting cycle and its purpose is to be sure that sum of debits equal the sum of credits before the start of new accounting period. It provides the openings balances for the ledger accounts of the new accounting period. This is the end of the accounting cycle. In the next accounting period, the accounting cycle will be repeated again, starting from the preparation of journal entries, for example, the first step of accounting cycle.